Dividends investing is probably one of the easiest ways to get started with stocks investing. Now, why is that so? It helps you lower your capital at risk every time you receive cash dividend in your bank account. Let's just say you spend 1,000 ringgit buying 1,000 shares at 1 ringgit each of a particular company. And within the first year, the dividend payout is 500 ringgit. Your capital at risk is actually 1,000 ringgit minus the 500 ringgit you've received in dividend. So you're only risking 500 ringgit at that point in time. In this video, I'm going to talk about 3 important numbers that you should look at before you begin your journey as a dividend investor. Coincidentally, a good friend of mine, KC Chong, just published a book called The Complete Guide to Dividend Investing, and he's having a book launch event this Saturday, the 22nd of October at MPH Midvalley at 10:30 a.m. I've been very honored to be given the privilege to interview him at this book launch event. So KC and myself are very looking forward to seeing you at the event, and especially if you want to get a copy of this book personally autographed by KC himself. So as a dividend investor, the first number you should be looking at is dividend yields percentage, or DY percentage. Now, what is the formula for DY? It's very simple. It's dividend per share divided by price per share. Alternatively, you can actually calculate it by market cap divided by the total dividend payout for that particular year. You should yield the same result. Now, once you have this number, how do you actually use it? How do you apply it? You actually benchmark it. Normally, you benchmark it against a fixed deposit rate or the risk-free rate that the current country is actually giving to you. Like, for example, in Malaysia, the fixed D rate or the current risk-free rate is roughly between 2.8 to about 3%. Now, subject to Bank Negara increasing the rates coming soon, that it should be your dividend yield benchmark too. The problem about dividend yield is this. If you look at the formula, dividend doesn't change within the year. It's like declared at each quarter. Sometimes they only declare once a year or twice within a year. But the price per share fluctuates every day the market is open. Therefore, I'm going to show you a case study how dividend yield is actually very heavily influenced by price, and you should be very well aware of that. In this case study, we're going to show 2 companies that are very famous for paying dividends in Malaysia, which is Nestle and also Maybank. For an investor, it's actually very easy to derive or to actually obtain the dividend yield, because if you type in Nestle, Malaysia share price, or market cap, or Maybank share price, you will be able to get those numbers off a Google search. As you can see, Nestle Malaysia dividend yield 1.73 and dividend yield for Maybank is 7.7%. Now, to show you how market cap or share price actually heavily influences the dividend yield, let's use Maybank as an example. If Maybank's share price, instead of 8 ringgit 56, actually doubled tomorrow, that would be 16 ringgit, 17 ringgit and 02 cents, all right? Therefore, market cap also doubled to 204 billion instead of 102. What happens to dividend yield? Dividend yield would have halved. Instead of 7.7%, it would have been 3.75% instead. And if Maybank's share price actually halved, that means from 8 ringgit 56, it goes down to 4 ringgit 25, dividend yield would have doubled. Because, if you look at the formula, total dividend paid remained the same, but market cap has now halved, therefore dividend yield has actually doubled. So as you can see, when you look at dividend yield, it should be looking at that particular date or that particular circumstance only. And the best way to see dividend yield is not in just one number in isolation, because at that share price, but it should be looked at as a long-term trend. Therefore, instead of this normal acronym that says, or normal belief or statement that says buy low, sell high, you can actually jokingly tell your friends you can buy high and sell low. What do you mean by buy high and sell low? You buy at a high dividend yield, which means the share price has actually tanked or halved, and you sell at a low dividend yield, in which share price has actually gone up. That means dividend yield has actually come down. Now, a little bit of a mind twist, but you get the hang of it once you do 1 or 2 examples. The second number you should be looking at is the dividend payout ratio. Now, how do you calculate the dividend payout ratio? It's just the annual dividends paid or total dividends paid against the net income attributed to common shareholders. That means another term for it is total net profit or total net income. Now, this number is important because it wants to show how much of the dividend payout is actually derived from the net income. So if you made a net income of 100 million and your total dividend payout is 100 million, then your dividend payout ratio would be 100% or 1. Now, more importantly is this: how do you determine whether this company's dividend payout ratio is sustainable? Because if it pays out its entire net profit to you as dividends, do they have enough surplus or leftover and enough working capital to be able to run and grow the business? So in a case study shortly after this, I'll show you how to look at certain companies and whether it is actually sustainable by paying out so high of a dividend payout ratio. So this particular case study, I'm going to use Hap Seng Industries Berhad. We may not, some of us may not know the name of the company, but I'm pretty sure as a Malaysian, you would have consumed some of the products they produce, which is this ping pong cream cracker that they're so famous for. Now, looking at the numbers from left to right, the numbers, sorry, not the numbers, but the bar from left to right, in 2016, they made earnings per share or EPS of 6 cents. And the dividends they pay out was 0.04. So made 0.06, paid out dividends 0.04. That gives them a payout ratio of 64.7%. Now remember the formula I gave you: dividends per share divided by earnings per share, which will give you the dividend payout ratio. Now in further years, 2017, 2018, 2019, you realize that the dividends they paid exceeded the earnings per share that they have actually did for that particular year. So how is this even possible is most common question. Now, the reason why they're able to pay more than their net profit is because, one reason is because they may have retained earnings. That means they paid only 64% dividend payout in 2016. That surplus that they remained or kept can be used to pay out a higher percentage ratio in future years. And it has manifested itself 2018, 2019. It paid more than 100% of its earnings. And as you can see in 2020 and 2021, even though, in 2021, I think they paid a special dividend. That's why it's like 161%. Either that or there's an error in Ticker's numbers. But the point I'm trying to highlight is this: the payout ratio is actually a determination of how much dividend is being paid out of the net income. The moment you see 100%, that means whatever dividend they paid out is equivalent to the amount of net profit they made for the year. More importantly is this: do they have enough surplus money in order for them to pay out this dividend and still actually have enough left over for working capital and to grow the business? So do remember also this: net profit does not equate the amount of cash flow that a company actually receives, because in accrual accounting, revenue is recognized the moment it is actually invoiced, and expenses is recognized when it's just expensed. It's not actually when you see an exchange in cash flow. So therefore, net profit doesn't necessarily mean cash flow into the company. Therefore, if we look at a more important number, which is the third number I'm going to talk about, is the free cash flow ratio against that of the dividend payout. Then you'll be able to ascertain whether there's real cash being grown within the company to be able to pay out the dividends. Now, all of that leads me to the third number that you should look at as a dividend investor, which is the free cash flow coverage. Now, don't worry if you're not familiar with free cash flow. I'm going to explain it very concisely here. Free cash flow is just the operating cash flow from the business net of the capex for the business of that year. Now, why is this number important? Anytime a company wants to grow, most likely they have to spend capex or capital expenditure to either build a new factory or to expand the existing facilities that they have. So whatever cash flow you receive from the business, which is your operating cash flow, net of the capex, it would be the surplus money that you can either use it as retained earnings to keep within the company, or you can actually use that to pay out the dividends to shareholders. So that money or that cash flow is actually internally or organically generated within the business. And that is a more truer measure of the company's ability to actually pay you dividends. So the free cash flow coverage ratio is actually the free cash flow divided by the total dividend payout for that particular year. I hope whatever you've watched has brought value to you, and if it did, please hit that subscribe button, give me a like so that the YouTube algorithm can share this with more people. And if you want to know when the next videos are out, hit that notification bell as well. Now I'm going to demonstrate how to use the free cash flow coverage ratio. The first company I'm going to use as an example is famous or infamous, for the lack of a better word, is this company called Serba Dynamic, and I'm going to benchmark them against Hap Seng Industries, the company I used earlier as well. So if you look at the green columns or the green bars, this is the free cash flow for Serba Dynamic. And in 2016, it was minus 53 million and minus 171 million. That means whatever cash flow they had from operations, net of the capex that they were spending to grow the business that year, they actually did not have positive free cash flow. While 1 or 2 years of negative free cash flow is actually acceptable, but having continuous negative free cash flow doesn't necessarily bode very well for the company. And in this case, it didn't really bode well for Serba. In Hap Seng's case, every year from 2016 all the way until 2021, they had positive free cash flow. So in 2016's case, 29 million, and they paid out dividend of 32 million. That means they almost covered dollar for dollar whatever they generated in free cash flow, equivalent to the amount of dividend they paid out. Now, in 2018's case, you can see that the dividends being paid out was 48 million, and they have positive free cash flow of 41 million. So, as you can see here, the trend between Serba versus Hap Seng, whatever that Hap Seng paid out in dividend was generated from the free cash flow that they internally generated within the business. Whereas Serba, if you can see, they continuously paid dividend. Even in 2021, they paid a dividend of 232 million, even though they had negative 1.2 billion free cash flow. So where is the money coming from? That leads to the question of the sustainability of the dividend payout. How did they get this cash to pay dividends to shareholders? Very likely, and obviously this would warrant another video, but very likely they either raise equity, that means they raise more money from shareholders, or they borrowed debts to actually pay out dividends to the shareholders to keep them happy. But instead, they should be focused on generating internally generated cash flow or revenue or the profit from the business to be able to pay the shareholders. Therefore, free cash flow coverage is a very, very important number because it really determines the source of your dividend payout to the shareholders. So besides these three numbers that I share with you as a dividend investor, I personally do not like companies that pay out 100% of their net profits to shareholders as dividends. Now, why is that so? For a very simple reason. If the business is doing so well, scalable, has a potential to reinvest whatever they have into the business to grow, I don't like to be rewarded upfront, but rather rewarded by 3 times the net profit of the company in the future, what they have today. Let's just say they're making 100 million, but because they can redeploy a lot of that profit into growing the business and make the profit 300 million, let's say 5 years from now, I would be more than happy to allow management to retain all that earnings to grow the business. And usually when we see dividend payout ratios of 100%, those companies usually have difficulty redeploying that money to scale or grow the business, or they are so well run that whatever retained earnings that they have in the past or have very strong cash flow generation and very confident cash flow generation for their future businesses, that they actually don't need this huge retained earnings to actually grow the business. But I would personally prefer, especially if it's a young, I wouldn't say too young, but let's say a mid-tier company that's continuously growing, to be able to retain that dividend payout ratio to probably 50 or 60% or less, because then I know the management is actually very, very hard at work trying to redeploy that capital, trying to increase their return on invested capital and scale the business. But that's personally me. I know certain investors, they want certainty of cash flow coming into the pocket, and that's fair as well, because as you reach a certain age, you're in retirement and you want that certainty of cash flow every month. Yeah, that could be a style that you can adopt, because you may not have time on your side and you want it to supplement your living expenses as well as your income. And that's the beauty about dividend investing, because you can tweak, the term dividend investing is so wide, but you can tweak it to adjust it based on your risk profile, your age profile, and to see what is your time horizon, that whether you choose to be rewarded now or you want to be rewarded later. Definitely up to the individual's choice. So to conclude, I want you to remember 3 things. The first thing is dividend yield isn't an only number you should be looking at. By looking at a high dividend yield, it may just mean that the share price has actually tanked and the dividend yield has just gone up. And it doesn't necessarily mean it's a bad thing. When the dividend yield has come down, that means the share price might have shot up. And that's probably, if you're holding, it's probably, if you want to let go of some shares to realize capital gain, that could be probably a good time for you to cash out as well. The second important thing is to ensure that the dividend payout ratio is sustainable. Now, as I mentioned, the net profit doesn't necessarily mean cash, and therefore, when you look at the dividend payout ratio of 100%, it doesn't necessarily mean that the company has enough cash flow generated to be able to sustain that dividend payout. Which leads me to my last and third conclusion. Use the free cash flow coverage to check and ensure that the dividend paid is not through a raise of equity or a raise of debts to sustain that happiness in the shareholder, but in actual fact, the company is actually not growing and getting organic cash flow to sustain that dividend. Therefore, never look at one of these numbers in isolation. Make sure you do all these 3 checks. And more importantly, as an investor, understand the business. Because when you understand the business, you will be roughly able to gauge whether the dividend being paid out to you is sustainable. Like companies like Coca-Cola, very simple to understand business. I believe consumer behaviors don't change as drastically, especially in drinks. You may see some pivot towards healthy drinks, but even then they're in that healthy business. But Coca-Cola, understanding its business will help you gauge whether that dividend payout is actually sustainable. All the best in your investing journey. If you can make it this Saturday, the 22nd, I'll see you at MPH Midvalley at 10:30, and KC is looking forward to seeing you there at the event too. So on to the next video and see you guys. Bye-bye.